Today we're going to talk about your Social Security benefits or your Social Security check and how the income tax is calculated on those. So the benefit of listening to this is going to be that you're going to know how you get taxed, and you can, if you learn this and you get some handle on your other income or your combined income or your taxable income, and we can plan that going forward, you know, maybe you can keep more of your Social Security check and pay less taxes. So if you have substantial income, that's a key word, substantial income, in addition to your Social Security check, which is a lot of people, you're going to pay, well, you're going to pay no more than 85% of your Social Security check, or another way to put it is 85% of your Social Security check is going to be taxable. Okay, so that means 15% of your Social Security check is going to be tax-free. So always, even at the highest incomes, 15% of your Social Security income is tax-free. And most states don't tax Social Security. Some do, many don't. So we're just talking about federal income tax here. So that's one category of people that have substantial income, and you're going to really want to pay attention to this. People who live just off their Social Security, and that's all they've got, they don't really pay any taxes, federal taxes at all, because it's all tax-free, because it just, this other income, they don't really have any other income, or they're just very, very small. People who have a smallish amount of other income, let's just say like $1,000 a month or $12,000 a year, and their Social Security check, they're not going to pay much taxes either, because their other income is low enough that, first of all, there's not going to be much tax on that. It's not even over the exemptions amount. And then this formula is going to work for them, that their Social Security check is still going to be tax-free. But you want to understand this, and you really want to understand it going forward, so that you don't all of a sudden get surprised with a big tax bill. Okay? So now, the real key thing in this formula is this word that the IRS invented, and the Social Security Administration, in combination with the IRS, invented. It's called combined income. And the formula can look a little bit complex, and it's really not the intent of this video is to teach you this and have you all at home doing a bunch of math. That's not really what I'm trying to do. Is I want to educate you to where you're going to understand this is how my tax software or my CPA or accountant that does my taxes, this is how they're going to arrive at how much tax I pay on my Social Security. And then when it comes to us, when we're financial planners, I'm a certified financial planner, CFP, and we do a lot of retirement income planning for folks, because we're going to look at your wages, self-employment income, dividends that you receive, interest, and other taxable income. And this other taxable income many times is retirement accounts. So if you have an IRA or a 401k and you're making withdrawals, that all counts as other income. So if we're going to put together a plan that we're going to map out the next like 10 years for you, we want to plan this and smooth it out. And we don't want to use this formula as the driver of everything. We just want to consider it so that you, if you're around these thresholds, that we space out your income in such a way that we reduce your tax bill. Okay, so with this combined income, it's going to make a difference. Is you're either filing a single tax return or an individual tax return as one person, or you're filing a joint return. And my guess is most of you know which category you fall in. If you're married, but you're filing separately, they kind of make this simple. You're going to pay taxes on your Social Security benefit. I mean, so they've worked all that where if you do separate returns, but you're married, you know, just this stuff doesn't apply to you. So that's a reason that many people who were doing this, once they get on Social Security, they change to a joint tax return just so they can benefit from this. Okay? So when we look at the combined income, is they've got a formula over here with Social Security that they come up with this, but I'm going to show you what the thresholds are. So if your combined income for an individual is between $25,000 and $34,000, half of your Social Security income will be taxable. That means half of it is non-taxable. If it's over $34,000, 85% of your Social Security income is taxable. If you're married and filing a joint return, these numbers don't double, but they go to 32,000 to 44,000 creates the 50%, and more than 44,000 creates the 85%. So again, I don't want people to necessarily be working the math on their own. If you want to do that, go ahead. There's actually some calculators that we have, and you can find them on the Social Security website that you can plug in things, and it's gonna do the math for you. But just to understand, what they're doing is they're going to take your adjusted gross income, which is all of this stuff, with money other than Social Security. They're going to add in any tax-free bonds that you have or tax preference items, things that you're getting around the regular tax. They're going to add them back in, and then they're going to take half of your Social Security income. Put all that together, that equals the combined income, which is the number that we're going to need to plug in that formula. So again, why is all this important? Well, it's important to understand. I mean, for past years, there's nothing we can do about it. We just let the software calculate it. Even the current year, there's some things we can do about that, because we can have an effect on what our other income is. So there's many people drawing from their retirement accounts. They're under 72, so they don't have to draw from their retirement accounts. Maybe they don't need the money, but they're just drawing from them, and that's creating other income and other taxable income, and perhaps they're going to make those less. There's many people who are not drawing from their IRAs because they're doing just fine off of their Social Security. I mean, you don't have any control going forward, like if you're working part-time and you're earning some money. I mean, it's not like you're going to stop working over this formula. But when it comes to that retirement income that you are making the election to withdraw out of your retirement accounts, we, with a good retirement plan, can manipulate that and control that and smooth it out so that you work well under this formula. So I'm Hans Scheil, and I thank you for listening.